Hey everyone, welcome to another episode of Mayhem in the Markets, coming to you Monday, June 19th from MacroVisor, where we make macro accessible and actionable. Last Thursday brought us the most intense call buying in the S&P 500 that we've ever seen. And this is a bit of a sign that maybe, just maybe, sentiment is getting a little bit blown out to the upside. We can see it in a number of different areas as well. Retail flows are getting maxed out. CTAs are very, very long this market. Hedge fund exposure in aggregate, when we look at net leverage, it's extremely high versus what we've seen for the past year and a half. And I think we can see it in the aggregate options positioning in single stocks, where we're starting to see call skew again. After about a year of put skew, call skew is becoming more common in single stocks. That reflects that people are looking for upside rather than downside protection. And so there's some dynamics underneath the surface here that are worth paying attention to. We do see some short covering into this as well, whether it's people getting reduced exposure to ETFs, to single stocks, or to equity index futures. And my overall takeaway is just look at it for what it is. This is a situation where the markets run up very quickly with multiple expansion rather than earnings improvement driving that run. An already expensive market has become more expensive. So I think eventually fundamentals and the macro picture, which is continuing to deteriorate, albeit at a slower pace than many suspected, will eventually matter again. And I would say that this 4,400 level that we're seeing in SPX, since we're speaking about options, is going to be a pretty important level to keep an eye on. We can see the short covering in this chart. This is from Goldman Sachs, as was the prior chart. And this is weekly ETF short flow. So we can actually see them covering. And this is the most covering that we've seen really since late 2022 when the market bottomed. Now, this is a good sign in the sense that some of this exaggerated positioning is being unwound. But it also could, because we're not at a moment of fear reversing here. Instead, we're in this sort of melt-up mode. It really does give shorts more ammunition to come in when they feel comfortable. So that's the other side of this. We're seeing some normalization of this positioning. And remember, they weren't extraordinarily short. They never really were. If anything, these ETFs were being used as hedges for long books. But we are seeing some of those shorts taken off. We're also seeing a little bit of unwinding of longs. There is some institutional selling into the recent gains that we've seen. And overall flows have also shown that the great rotation theme that I've discussed before is underway. Fixed income bought, equities sold. I know it doesn't look like that, but we have to take into consideration the role that short-term trading, particularly in options, put selling, call buying, is having on aggregate price across a number of different measures, whether it's sectors, industries, entire indices. We do see the influence being exerted. And the Magnificent Seven bubble, this is not a measure of breadth, actually. It's a measure of market cap weight. So the biggest 7 stocks in the S&P 500 account for nearly a third of the index, 28.2%. Now, this is the highest reading that we've seen since really the market started to top out in late 2021. Why does it matter? Because there's about 15 stocks in the S&P that account for 90% of the upside. The Magnificent Seven are clearly carrying most of that weight because the index itself is up a marginal amount compared to what we see from just these 7 stocks. In fact, if you look at the Magnificent Seven, they're up close to 60% year to date. And if you look at the not so magnificent 493, they're up about 3.5%. Apple is worth more than the entire Russell 2000 put together. Now, this speaks to the absolute enormous amount of business that Apple does. The AirPods that they sell actually make more money than all of Netflix revenue combined. Just think about how massive that is. All they had to do was remove the headphone jack from your phone. And now you got to buy these AirPods because most people don't want a tether. They don't want a little, replacement dongle or whatever they've got to put into the phone to make their headphones work. I mean, I know I would lose that. If I got one of those little adapters for USB-C to headphone, I'm sure I would lose that. That would be my hunch. So the wireless AirPods, and then everyone else kind of went in the same direction, removing headphone ports, providing wireless options. It became an industry trend. But Apple, their deprecation of features has been a net benefit for them. And they've really done a good job. And if you actually look at the inside of a US iPhone 14 or any of the prior models going back to the 7 when they removed the headphone jack, you'll see it's just a block of plastic. Again, this is in the US models. It has to do with the lack of a SIM slot because of eSIMs, but it's still really interesting to see that. And when we look at companies that are becoming this large, Apple quickly approaching $3 trillion of market capitalization. It's incredible to consider just how big that is. That's bigger than a lot of stock markets in many parts of the world. Like, you could take all the stocks in an entire stock market in many different countries, including many countries in Europe and Asia, and you could put them all together. And Apple is still bigger by itself. So it is a titan of technology, but it might also be a little bit vulnerable. Year over year, earnings are flat, sales are down. Eventually, I'm going to imagine that might matter. I also think that the share buybacks distort the picture a bit. If we net those out, earnings don't look as flat. They look like they're going down year over year. And that's because share buybacks reduce the total number of shares in the float of a company. And so that means earnings per share with a reduced float looks better than maybe it should. There are a lot of schools of thought about buybacks. Some think that it's good for investors. Some think it's a great use of extra cash. I would just say that on the other side of it, one thing that allows very large companies to remain very large is building a moat that's very hard for others to impede upon. And a lot of that comes from CapEx. Now, Apple spent $600 billion buying back their own shares over the last 10 years. I wonder if they put 10 or 20% of that into R&D, where they would be with things like AI, where they seem to be lagging behind their peers. And again, yes, AI is in a hype environment where the thoughts about where it can go in the next week or month are far beyond where the technology is likely to go in that time frame. But in the longer time frame, over the next year, 3 years, 5 years, it will prove to be a major force in business, in governance, in our everyday lives, in good and bad ways. But it also has been in other ways, right? If you look at credit vetting, if you look at how sentencing is done, if you look at how HR processes resumes, if you look at a number of different areas, weather analysis, there has been machine learning, language learning models, and other variants of what we're calling AI that we weren't calling AI not too long ago. In fact, I think 6 or 7 years ago, JP Morgan actually created a language learning model for contracts that the bank was working with, and they got rid of a whole team of lawyers because this model was so sophisticated and efficient at what it did. But remember, we're just sort of hearing, as the greater public, hearing about all this stuff now. So it seems very new. It seems very fancy, like it's this big technical revolution that's happening underneath the surface. And granted, there is meaningful innovation happening there. Don't get me wrong. It's happening. I'm just a little concerned that the narrative may be exceeding the capability. I do still think the current situation with AI driving so much of returns, where 110 S&P companies are mentioning AI on their conference calls, but no one's really pointing to the key thing. Is AI expanding margins? Is AI increasing productivity in an environment where companies are paying more for workers and productivity by a number of different measures has been falling? Is AI offsetting that? Is it offsetting the margin compression from disinflation that we're seeing? Is it helping companies to continue to grow? And we're not seeing that. We are still in an earnings recession. We had 2 quarters in a row of negative earnings growth. It's likely we're going to have a third with the second quarter earnings season starting in not too long. But what I'm very curious about for AI, which I think is a show me story, is whether or not it can actually tell us, through the usage of this technology at a number of different companies, that it's showing promise. We need to see margin expansion. We need to see that meaningfully. We need to see companies on their conference call saying, you know what? We took 10 different jobs and we replaced it with this one program, and now we're saving X amount, and that's improving margin by a number of bips, things like that, where we can actually have quantifiable gains in multiple different industries. Will it happen over time? Yes, it will absolutely happen over time. Is it going to happen at the rate at which it's being priced in? Now that's the question. And that would imply that we should start to see improvements within the next 2 quarters. But going into those improvements, what do companies have to do, right? What was I just talking about with Apple? CapEx. If companies are so stuck on buying back their own shares, that's not the money going into AI and building that potential for productivity improvement, for margin expansion. So the other thing is, it's going to cost companies money, and that money is not going to be immediately returned to investors. So will we see the requisite level of investment that is necessary to achieve those potential gains in margin and productivity? We'll see. The jury is still out on that one. That's why I call it a show me story. Here's the S&P 500. This is a chart I made. I realize the arrow is a little crooked, but it gets the message across. We are looking back to just before the Fed first hiked rates in March of 2022. What do you see? You see an S&P 500 cash index that is, depending on where you're looking at it, at least 100 points higher, maybe as much as 200 points higher. Nevertheless, what it's showing you is that the Fed's hiking cycle, and the most aggressive hiking we've seen in decades, the biggest rate of change I think we've ever seen, because we started zero bound on rates, and the largest runoff of their balance sheet, although, that could be argued was interrupted by Silicon Valley Bank and the facilities put in place to buffer the banking system since. Nevertheless, this was a very aggressive Fed going into this year. And then their tone changed. Remember February's meeting? And if you follow me closely, you probably remember I was pretty critical of Powell. I even asked if there was something wrong, because he seemed visibly anxious. And, I know there's a lot of critics of the man out there. I think the Fed as an institution deserves some degree of skepticism and criticism and objective examination for the harm that these boom and bust cycles driven by excess cheap liquidity, and then the removal of all that credit and the increased cost of capital, that boom bust cycle causes a lot of harm. But whatever you might think of the Fed, or whatever you might think of Powell, he's been a good communicator. He can go out there and talk about what the Fed is going to do and where he sees things, and outside of their economic projections, and inflation is transitory, which fits in that bucket, their policy communication was pretty good until earlier this year. I had been a fan of their policy communication, because we're coming from years and years and years, decades even, of the Fed basically obfuscating the language of policy on purpose so that the market didn't know what to expect. For a long time, they felt that was the appropriate course of action. And then under Powell, increasingly, transparency of policy communication became key. And that was good until it wasn't. And I think that it started to fall apart in February's meeting. You see, the Federal Reserve's policy framework isn't just how they impact the markets or the economy. This Fed embraced the idea of managing sentiment. And we all remember that the bear market started really before there was a single hike, before QT started. We saw expectations management be a key MO of this Fed. They worked to jawbone to manage expectations so they could try to pull some of the psychological demand destruction impacts of the tightening cycle forward in time. That is to say, to condition people to recognize this is where we're going. We're going to be aggressive with our tightening. You should get ready now, batten down the hatches, all that. And so you could argue that they did a great job kind of managing those expectations from the beginning. No one was terribly surprised when they started hiking because they've been talking about tightening for months. No one was particularly surprised when they started QT because they had been talking about that for, I mean, they started in June of 2022. They had been talking about it since December of 2021. So they set expectations well until February, where Powell started saying things like financial conditions had tightened measurably, since the last meeting. And you look at any objective measure, whether it's the Bloomberg Financial Conditions Index, the Chicago Financial Conditions Index, the one that measures national conditions, an aggregation of all sorts of different products. You could see that there was not this tightening of financial conditions, and stocks were beginning to shrug off the Fed more and more, not believing their terminal rate projections, not believing the duration of the tightening, despite the chair repeatedly saying, this is what we're going to do. And so we went from a market that in late 2021, particularly December and January of 2022 on, was hyper focused on everything Powell said, up to that big, everyone's going to remember Jackson Hole, right? That big fire and brimstone speech that Powell gave. There was no policy that day. He didn't hike. He didn't do anything. He just said, there's going to be pain. And he had a speech written that he scrapped. And he didn't do a press conference. He didn't want to talk to any. He just wanted to get out there and scare the crap out of the market and try to manage expectations because policy wasn't working the way they'd hoped. And of course, they were fighting against legislators too. The Congress was going out there spending inordinate amounts of money on this late cycle stimulus, right? CHIPS and Science Act, the ironically named Inflation Reduction Act, which isn't going to have that effect in the near term. But here we are. And the Fed at Jackson Hole, Powell said, I'm not doing this speech. I'm going to give my own off the cuff. Let's just kind of set expectations the way we used to, and let's get people a little bit more concerned about where policy is going to go so that we can deflate some of these wealth bubbles, so that we can try to reduce demand and get inflation, which at that point was raging, under control. And I think, he did a good job there. He was not scared to rattle things. But as time went on, we started to see that unrealized losses at banks were growing. The Fed sees this data much more real time than we do with the lags that we see in earnings releases and FDIC and other data aggregates. So in February, it was pretty clear to Powell, in my opinion, that something was wrong. And on Macrovisor, I wrote on February 2nd that I felt there was some potential stress in the banking system. I also wrote about it and talked about it at TraderAid, where I equated that some of the zero-day options activity was helping to float things back up so the banks would be able to exit some of these losses on their equities and fixed income that's tied to equity performance at better prices, right? And so here we are on the other side of this. Hundreds and hundreds and hundreds of S&P points later. Not only have we had the banking crisis that I was concerned about, and when I wrote about it, what I said was we're seeing discount window borrowing in 2022 increase. That's never a good sign. We're seeing the lowest capital buffers for banks in terms of percentage that we've seen since 2006, which indicates that they're vulnerable. And we're seeing, M2 supply falling, which always puts pressure on lenders. It also puts pressure on debtors because there's less money in the system to pay back the interest on the debt, which is essentially new money. And I talked a little bit about what I was seeing with unrealized losses, which at that point was over $600 billion, right? It was just shy of $700 billion. Now we're in a bit of a different period. Those unrealized losses are down to $500 billion. We're seeing some improvement. We are also on the other side of that regional banking crisis where I was saying, I think there's something wrong in the banks. Now, I don't think that the problems are gone. I think that we had a liquidity crisis. We're still likely to have a credit crunch later this year because commercial real estate remains a big problem. There's over 1.2 trillion of commercial real estate debt that's coming due over the next year. And that's probably a modest measure. A lot of it is revolving debt, so it's already becoming more expensive as rates rise. And refinancing is going to be hard, particularly in office buildings where they have the lowest utilization rates ever. in many major metropolitan areas, and as a total measure, ever. So again, there's some issues there. Life insurers hold $900 billion worth of commercial real estate debt. Regional banks own the largest share of what banks own. So banks own 50% of commercial real estate debt. Regional banks own 75% of that half, right? So it means that they're more exposed. So these are risks that are building. The market seems ambivalent about them. It seems ambivalent about the Fed. It doesn't believe the Fed. And Powell has done himself no favors, repeatedly undermining their credibility, including at this latest meeting. So February was a big waiver. This latest meeting was a total disaster. The press conference was a contrast to the statement. Now, some people disagreed with me about this on social media, that the press conference wasn't very hawkish. If you listen to every single press conference that Powell's given this year, this one toned it down a bit, but he also wasn't convincing. His demeanor was very laid back and complacent. And I read into that as well. But the biggest thing was the way the market reacted. It shrugged off the entire reaction to the press release and actually closed higher on the day. And then on Thursday, it rallied significantly. Now, some were saying, oh, this is just OPEX week. That's what happens. And granted, there were a large amount of delta and theta decay flows. Those typically happen in the first and last hour of trading as market makers are squaring up their hedges. But this was a little bit different. I believe it was more than just OPEX. And here's why. Because not only was it the way the equity markets moved, it was also the way the bond market moved. It was the way the currency market moved. It was the way the commodities markets moved. They all started to discount the Fed. And so that can't just be options activity, because the majority of the sort of theta and delta decay that's going to happen is going to be in SPX, where there was about $2 trillion running off or rolling off in the AM of Friday, right? So that decay would accelerate and accelerate, but then it would stop. Now we're at the point this week where those flows are gone. So we'll see how the market does. But because I saw a bid in bonds, a bid in commodities, some selling in the dollar, and it continued, that told me, you know what? This market doesn't believe the Fed. Neither does Fed funds futures. It's not pricing in a second hike. And it only recently discounted the chance of a cut as early as December. But it only pushed it off to January, and the Fed is saying they're not going to cut anytime early in 2024. So this is, again, a Fed that's now having a harder time managing the narrative because their own ability, particularly to sort of have Chair Powell come out there and make this seem real, seems a bit limited. I'm just not... Look, I went from being very impressed with their ability to set expectations and communicate to very skeptical. I think they've lost control of the narrative. And that's what this chart tells me too, as do a number of others. Fed funds futures, where we are with rates, financial conditions, valuations. And then you can see the market's getting ahead of itself because risk premiums are the lowest. They're in fact inverted by several measures. They're the lowest that they've been in over 2 decades, right? So there's definitely a case for more fixed income buying here. Here is a balance sheet of aggregate central bank assets versus the price of the S&P 500. And what do we see? We see a growing divergence. I think it does matter. We'll look at this a little more closely in a different chart, variant of this. But that gap matters, and I think it's just sort of more evidence about how we are diverging from liquidity in the system. This was the biggest driver of the rally. So to have such a divergence, it's slightly concerning. When we see divergences like this in the past, they can last a while, but they typically end poorly. 2018 was one such occasion, and that was when the Fed was tightening and running off their balance sheet. We could see that enormous divergence. It's like that sort of created a blow-off top, and then we had that nasty sell down in December. Now, past is not prologue. We could have a completely different outcome. This time, options are playing a much bigger role setting price. Maybe that will be the catalyst for whatever comes next, whether it's good or bad in terms of equity prices rising or not. Next up, we have AAII, bulls versus bears. And what we're doing with this is we're just looking at the number of bulls versus number of bears on this sentiment survey. Now, this survey is a bit noisy, So the only reason that I really look at it is for extremes, but more for bullish extremes. And here's why. Because bearish extremes in sentiment don't necessarily mean that mostly long only investors are jettisoning their holdings. There's considerations like capital gains or time horizon. You can have someone who's long up to their eyeballs and still very bearish of the market. But when people get very, very, very bullish, usually that sentiment would indicate that they're adding to positions. And that's where I would get a little bit more interested when it reaches an extreme, which we have. We're now at the highest level since November of 2021. And what followed wasn't particularly good for a lot of investors, but that's where we are right now with this AI hype cycle. The other thing I would note is just how fast this weekly rate of change was. That one, not the current reading, but the prior, that was one of the biggest changes since 2020. So, maybe it was 2021. You can see that change in February to March. That was pretty significant. But nevertheless, it was one of the biggest changes in years in sentiment. A bounce from some level of bearishness to extreme bullishness. And that's something where you see things get a bit lopsided and it starts to reflect in other areas of the market. So it's something that's worth watching. We can see this in this chart from Bank of America. This is retail net purchases. We're comparing it to the Russell 2000. But what we can really see here is that retail has bought, and I know I'm retail, you're retail, we're all pretty much retail. There might be some institutional folks listening. Hey, out there if you are. But this is extreme. This is another reading that's the highest since late 2021. Why does it matter? Because, wow, people are not only bullish with their sentiment, they're putting their money where their mouth is. And see how the outflows aren't nearly as big as the inflows on these readings? This is another reason that I only look for the extreme bullishness. Because you can see the outflows are very tame in comparison, even during like horrible bear market environments like the crash of 2020 or the whole year of 2022. The inflows, when people get very excited, they go crazy. 26.7 billion. So take that into consideration, what's happening with everything in this market right now. Stock indexes recover basically as if there was never a Fed hike at all. This is similar to the chart I showed you before, but I wanted to do it a little differently here because this is a nice one from Bloomberg. They've got the NASDAQ below here. So while the S&P is pretty much discounting the hiking cycle completely, as if it never happened, the NASDAQ is actually taking us back to some of the highs that it made. Before we saw the bear market really kick into gear, right? It made a meaningful lower high there before it rolled over. Now, to me, this is a really interesting chart because it's as if the entire Fed cycle for the NASDAQ 100, the hiking never happened at all, and we're actually completely back in a bull market environment, despite risk premiums being inverted, despite valuations being extremely expensive for most tech stocks. I mean, NVIDIA with a price earnings ratio of something like 200 and price sales of something like 40 it's a little bit on the extreme side. Is the technological advance that they're making in semiconductors meaningful? Absolutely. It's extraordinary. They're doing amazing things over there. It's not worth the valuation. Like if you were a late comer to this thing, I don't think that I would be buying NVIDIA at this current price. Put it that way. I do think these things are in a bubble environment. I do think it's something to be wary of. It doesn't mean they can't go higher. Saying something is in a bubble doesn't mean that the person saying it is like net short with their entire net worth of whatever they're saying is in a bubble. So I don't have any short position against NVIDIA. I just think that it's gotten extraordinarily expensive. Now, if they're able to achieve some level of hyper growth, like their projections are saying their revenue is going to bump up to $11 billion in the next quarter, then that's amazing. That is truly remarkable. But if they can sustain that is the question. There's a lot of companies that are ordering these new chips, but the refresh cycle on these things is going to be a matter of years. So once a lot of data centers, cloud providers like Microsoft and Amazon, et cetera, have added AI accelerators, what's the growth in data center going to look like? Are we going to see a global revolution in AI carry out over the next several quarters, or are we front loading some of this with that buying? And then the refresh cycle is going to be a matter of when the next major technological breakthrough is, and if a lot of these applications that are being accelerated are really able to take off to the scale that it warrants additional capacity. Remember, it's still a show me story. We still need to see margin expansion and productivity improvement directly attributed to AI by a lot of S&P companies in different sectors so we can quantify that this is real. I'm not saying that it won't eventually be real. I just think that people are getting a little too excited in the near term. And here is that famous chart of TLT versus QQQ. TLT in red, QQQ in black, and the jaws are wide open. Now, eventually, this will matter again. This correlation is actually a longer term correlation. So I always get people asking me, what does this look like over the longer term? Now, granted, it's not the same maturity. It's 10-year rather than the 20 and 30. But here's the inverted real 10-year yield. So we're compensating for inflation versus the S&P 500 technology index. And this one is going back over 5 years. So it's showing us that this correlation between invert rates, right? Inverted rates are very similar to the price of a bond in terms of what they look like on a chart, and the performance of the S&P 500 Information Technology Index, which performs quite similarly to the NASDAQ. Why does this matter? Because this is an enormous divergence, and it's something that I believe we should keep an eye on, because I do believe that eventually it will be reconciled. That could have to do with yields moving lower, as well as stocks moving lower. But eventually I do believe that this gap will be reconciled, and the more sort of divergent it becomes, the more it's like an elastic band where eventually it snaps back with greater and greater force. And here's a view of the S&P 500 versus what's called net Fed liquidity. So that's the total size of the balance sheet of the Fed subtracted from the TGA and reverse repo total size. And what this is doing, in essence, is showing how much liquidity the Fed is contributing to the system. It's not a perfect measure. I know there's a lot of critics of these different types of charts out there, and that's fine. I don't think there's going to be any perfect analog because there's so many different variables to measure. So this is just one way to look at net liquidity from the Fed versus the broader market. It does suggest there's a growing divergence here. It does suggest, as we saw with the prior charts, the jaws are widening in this measure as well. So there's some heightened risk. It doesn't mean that, we're immediately going to have a bearish outcome, but what it means is that the risks of such an outcome may be growing. And the Shiller PE ratio sure is high. The current ratio is 30.19. The median is 15.93. The mean is 17.03. The max was established during the dot-com bubble, 44.19, not terribly far away from there now. And the minimum was 4.78 in December of 1920. It was actually before the Great Depression. The Great Depression got close, but actually never got below 5. So objectively, the market is expensive. Looking at trailing PE, looking at forward PE, it is still expensive for a lot of companies and the broader indices. I think that it's unlikely, with earnings continuing to go sideways to down, that companies are going to grow into their multiples. So the concern becomes, do we see a re-rating of risk? And earnings recessions tend to bottom around negative 16%. Morgan Stanley sees similar downside this time around, which would mean the second half of 2023. They believe that earnings estimates remain far too high. So they put a projection together showing what that might look like versus where we are. And I do have to agree. I think the estimates are a little bit high, although companies have been handily beating them. I don't think we've seen the worst of the downtrend in earnings. And I think that's because we're seeing broadening softening in the economy. This really has a lot to do with the services sector, right? We've talked about this on Macrovisor Spaces before. We've talked about this on the website as well in some of our work and our research. But essentially, our belief is that the last respite of strength in the economy right now is the services sector. It's about 3/4 of GDP. So it's a really big contributor. It is the economy in a lot of ways. Manufacturing's been rolling over. We've had 13 months of declining new orders, 9 months of contraction in the index, the ISM manufacturing PMI. But we haven't seen that in services. However, what we just saw in services was a 50.3 reading on the ISM services PMI, which means marginal expansion. That's moderately good news for the economy because it wasn't contraction, but it's a not so reassuring trend if we continue to see that continue, which is to say further slowing into negative growth and contraction. Now, our belief is that if ISM services PMI goes meaningfully into contraction for more than 3 months, that we're going to see significant hits to the labor market and a recession follow. So the real call here is that if and when services roll over, employment and then the economy follows. And I think this is a very important clarification to make, and it's one of the reasons we haven't seen a recession yet, is services have remained relatively resilient until recently. The latest measures don't look so good in terms of the internals. New orders and backlogs are falling, and that's telling us that companies are not seeing the type of business activity that they would like to see, right? They are not seeing the type of orders that allows them to expand their earnings, their revenue, their company as a practice, as a firm. So I would be somewhat concerned about where that goes. I think we need to keep a very close eye on ISM services. We get some of the flash data this Friday. I'll be watching that very closely, and I'll report on it on Macrovisor. Particular focus on the services industry. As we know, manufacturing is still seeing some major headwinds. But that will have an impact on earnings as well. When services rolls over, earnings are likely to follow. Unrealized losses on FDIC insured banks, as we were talking about earlier, just about $500 billion now. Still a lot. And this is for the first quarter of 2023. What this is telling us is that there's improvement at the banks, but it's not enough. Still close to half of them have more liabilities than assets. That does put pressure on them. Should there be a liquidity crunch, the Fed has helped to alleviate that. So now we're more worried about a credit crunch and all that commercial real estate, the impact of that, and increasing stress in other lending markets. Leveraged loans are showing a lot of stress, the most since 2009. What that looks like in the back half of this year and going into next year. And core inflation remains far too high. This is core CPI, 0.4%. We annualize that, it's 4.8%. That's far too high of a rate of inflation. It's still going to make the Fed uncomfortable. An uncomfortable Fed is still likely to maintain a firm policy. It doesn't mean they're likely to hike, but it's less likely that they will cut. An average interest rate for all credit cards, 1994 to present. It is the highest it has been in a long time. And we're talking about, I'm going to say, and we don't have 94 or 93 on the chart, but I'm just going to say it's over 30 years. I don't see it being this high, except for if we go back to maybe the late 80s. But this is really bad for a lot of people. I mean, these credit card rates are extremely high. The average American carries a balance of over $5,000. Many are using credit cards to buy groceries, pay rent, pay utilities. Some are even using buy now, pay later because they've maxed out their credit cards. So they're using credit cards not to buy what they want with money they don't have. They're using credit cards to buy what they need with money they don't have. The average American does not have more than $400 in a rainy day fund. 40% are behind on their bills, and 2/3 are living paycheck to paycheck. With credit card debt hitting over $1 trillion, this matters a great deal. It does show us that lower income segments are struggling. And China's reopening isn't so much of a reopening at all, is it? Other countries around the world, we saw much more robust data coming out of COVID lockdown. China's not seeing that so much. We can see retail sales haven't rebounded nearly as much as what people thought they might. Exports are actually falling. New housing starts are falling. Home sales are very, very depressed compared to what we had seen in prior cycles. And fixed asset investment is also falling. So why does this matter? Because China is the second biggest economy in the world, and their reopening is not providing that stimulative impact that many had counted on. And that was one of the reasons commodities in a lot of emerging markets and Chinese stocks had such a strong bid. And now we're seeing maybe it wasn't so warranted after all. That doesn't mean eventually their markets don't recover. I just remain a little bit skeptical because the data we're seeing in that country isn't so great, and the government stimulus has been pretty limited. So I want to thank you for tuning in. I really appreciate it. I couldn't do this work without your support. I want you to take a moment to check out macrovisor.com if you haven't already. We've got a 30% off sale for your first year going on until tomorrow. Tomorrow is Tuesday, June 20th. Also, visit TraderAid.com if you want to learn more about technical short to intermediate term trading. We have a great Discord. We've just added a bunch of new features, options and stock alerts, news squawk throughout the day from 6 a.m. to 6 p.m. Eastern. And we have a 24-hour bookmap stream that's pretty darn awesome with customized audio indicators for large activity and unusual activity. And you can get 20% off your first monthly or yearly plan at TraderAid using the code Mayhem20. Follow me at Twitter, Mayhem4Markets. That's Mayhem4Markets. And be sure to like, subscribe, and share this video with your friends. And I will look forward to catching you all next time.